Hi, and welcome again. In this video, we will go through a Python code to backtest our upgraded trading strategy. The strategy was deployed live on the market for a few weeks, and in the previous video, we proposed some improvements to limit the risk and increase our profit. This video is a continuation of a previous work on developing a live trading strategy that we can deploy on the market. So if you haven't watched the previous video and the one describing the details of the strategy, I will leave some links for you in the description below. So now we will go through the Python code and we will be adding the RSI-based indicator. I will also show you how to apply forward multiple testing and the break-even trade management. If it's your first time on this channel, I usually share the Python code from the link in the description below. So you can download the code and use it for your own experiments. You don't have to copy it from the video. If you like the content, please don't forget to support this channel by pressing the like button and maybe leaving your impression and ideas in a quick comment. Okay, let's get into the coding part. So this is our Jupyter Notebook file. We're starting by importing a CSV file, the Euro-US-dollar 5 minutes time frame from 2023 up to 2024. So this is a recent data, as you can see. So we're not using older data like in the previous videos. In these lines, we are cleaning the fractions of seconds from the time, the GMT time column, and we are casting the GMT time column into date time, providing the correct format, the day, month, year, the hours, minutes, and then seconds. Then we are cleaning the candles where we don't have any movements. So these are usually candles where the high is equal to the low. These are weekends and days off. So we are not interested in these days. And then we reset the index as well. So the set index, GMT time, because this will be our index for the moment. Then we are applying the moving averages, both the fast and slow, like in the previous examples, the RSI in case needed, Bollinger bands, length 15, standard deviation 1.5, and the ATR that we'll be using for the trade management. Again, if you haven't watched the previous videos, this is why I'm going fast on these cells, because these were explained in the previous parts. In order to keep this video as short as possible, you can go back, I'll leave some links, and watch the previous videos first. But now we can follow along as well. So I replaced this function, the EMA signal, here by a vectorized version that works much faster because we need to test on a wider set of data this time. So we're not going to be to content our tests for a few thousands of candles. We need to go above this because we need to apply the forward testing as well. In brief, if the fast moving average is above the slow moving average for a while, for 7 or 8 candles or any number of back candles, here I'm using the number 7. In this case, we have an uptrend. And in the opposite direction, if we have a series of candles where the fast moving average is below the slow moving average, then we are in a downtrend and we return 1 as a result. So this is the vectorized version. It works much faster than the previous one where we're using the apply function here. So this one is kind of looping over all the rows. This one is more efficient. I also applied a vectorized version of the total signal as well. We have an EMA signal, a bullish EMA signal, so equal to 2. And at the same time, the current closing price of the current candle is below the lower Bollinger band. This is the buying condition. Then we return 2 as a result. This is our buying signal. In the opposite direction, if we have an EMA signal equal to 1, so a bearish signal, and at the same time, the closing price of the current candle is above the upper Bollinger band, then we have a short signal. So these can be modified a bit because we don't have to stick with the closing price. It can be the closing or the opening price as well. We might want to modify these and check what they will be influencing our strategy. And this is the addition that we haven't included in our live trading bot previously. So I'm using now the RSI. This is a new signal. We're adding a filter for the RSI. So not only we need these two conditions, the Bollinger bands and the moving average signal as well, we also need the RSI signal to be either bullish or bearish. And how does it work? Well, if you have a series of candles, a number of back candles, 5 candles, let's say, where the RSI is always above the number 50, the limit 50, for example, 50.1 here, then in this case, we are in an uptrend, it's confirmed, and we are returning 2. So the RSI signal is equal to 2, it's a bullish signal. If in the opposite case, we have a series of candles where for all these candles, the RSI is below 49.9, then we consider we have a downward momentum. It's more of a downward momentum. And in this case, we return 1. So if both the EMA signal and the RSI signal are showing bullish, then it's kind of confirming each other's. Same thing for the bearish signals. In any other case, we return 0 and we don't take the trend into consideration. So I added this part. It's a new column called RSI signal in the data frame. And then we have the total signal, which is also considering the RSI signal now. So what was previously called the total signal is now also inclusive of the RSI signal. Now, obviously, we would assume that in this case, we will have much less signals. So we're not going to have a high number of trades like before, but we consider that this is a better or more filtered and more selective model. And just to make sure that things work properly, we can visualize things on a graph, just like we have been doing in the previous videos. So notice this purple point right here. This is a bullish signal, and indeed we have a great signal afterwards. So we have an upward momentum. The both moving averages, the fast moving average is above the slow moving average for a while, for let's say 7 candles, the number of back candles. Apparently the RSI, which is not plotted here, is also above 50 for a while, for 5 candles at least. And the closing price of one of these candles is below the lower band of the Bollingers. And this is why we generated this bullish signal. Apparently it's working well. This one is a bearish signal. It's also looking great. And this one is a bearish one. We did have a retracement down. It's not very wide. There's no high volatility here, but it's still, the price showed a red candle afterwards. This one is also a bullish signal, as you can see. So from what it's looking here, it's working well. We're going to test this very thoroughly later on in this video. Now, for the backtest, we can take a slice of the data frame. Using the backtesting.py package, we can create a MyStrategy class, for example, and define our signals here. So if we have a bullish signal and we're allowing one trade at a time, so the length of the trades or the current open trades is equal to 0, then we define our stop loss, the take profit, and we apply a buying position. So we can pass a market position. Then if the signal is bearish, it's equal to 1, and we don't have any open trades on the market, same thing, we define the stop loss, take profit, and we open a short position. Then we define the size and we pass the take profit and stop loss as parameters. Then using this class, we can optimize, we can define a backtest here. So we're starting with the cash, $250, let's say, and a margin 1/30. So it's a leverage 1/30, defining the MyStrategy. So we're passing MyStrategy as an input parameter, and the data frame where we have the open, high, low, and closing prices. Then we have stats and heat map. So we're going to use these for our optimization, and we're going to optimize the strategy using this function. I'm just passing a grid style for searching for the best parameters for the take profit stop loss ratio, so the risk reward ratio somehow, and the stop loss coefficient, which is the stop loss distance based on the ATR distance. We're taking the ATR times this coefficient, and this is how we define our stop loss that takes into account the volatility of the market. So when we run this optimization on part of the data, so we're running just on 5,000 candles. Remember, 5,000, if we do the math, it's 5,000 times 5 minutes, because we are on the 5 minutes time frame, divided by 60. This is equal to 416 hours divided by 24. That's around 17 days. So almost 3 weeks of trading days. Over these 3 weeks, we could achieve 7.5% in return versus the buy and hold returns of minus 0.23. And we have an average drawdown of 0.6%. and an average or a maximum drawdown of almost minus 2%. So that's not bad for 3 weeks of trading. And the win rate of 52.8%. Now this is in the best conditions. Remember, these are the best set of parameters. What if we apply forward testing? Well, first of all, before we apply this testing, I'm going to show you the parameters. So here these are the optimized parameters. So the stop loss coefficient is 1.1. Take profit stop loss ratio is also 1.1. And if we visualize the results on a heat map, we can see the stop loss coefficient here on the y-axis, the take profit stop loss ratio on the x-axis. This zone is all in negative, and we should stick to this zone. So we will be using a stop loss coefficient of 1.1 or 1.2, and a take profit stop loss ratio of also 1.1 or 1.2, just to stick in this positive zone right here. Now, the idea of forward testing is to test these parameters on new data, because obviously these parameters would work on this data because we have tuned these parameters and we have fit these parameters to work on this set of data. And we're talking about this slice between minus 10,000 up to minus 5,000. So these are the 5,000 candles we use to train the model or to fit the model on. What if we tried the same parameters now on most recent candles? So between minus 5,000 up to most recent candle. It's the same number of candles. It's basically 5,000 candles. So we will be defining a new slice, a new data frame for testing. So minus 5,000 up to the most recent candle. And remember, most importantly, the model and the backtesting have never seen this data yet. So these parameters 1.1 and 1.1 that we have obtained from this optimization was conducted on the previous set of candles. So now we are running in the future of the model. If we test this, we notice that we have 8.39% in returns. So this is a good sign. It means that if we fit our model to today's market and we trade with these parameters in the next 3 weeks, we should expect some positive results as well, because the market doesn't shift in one day. It doesn't shift in 24 hours usually, or when it does, it's rarely the case. It usually takes some time to shift from one set or one setup to another, and we're counting on this actually, the inertia of the market. This is why if we fit on the last 4 weeks, we expect the model at least to work for the next week or two. So we're going to slide a window and every time fit on 3 or 4 weeks and test the model on coming 2 or 3 weeks as well. And plotting the equity, it looks quite promising. So we have a positive equity. It's always climbing, as you can see. We have a slightly drawdown period at the beginning right here, but we can measure this actually. So it's around 1,000 candles or 2,000 maximum. So 2,000 candles. 2,000 candles, that's around, I think, 5 days. We could do the math again. 2,000 times 5 divided by 60 divided by 24, we have almost 7 days. So that's not even 2 weeks, that's 1 week and a half, because we're talking here about trading days. Now, we could also include the break-even approach. So the way to do this in the backtesting part is that when we want to open a trade, we're going to open 2 trades. But instead of using the size of the lot, we're going to open 2 trades, but with half the size each. The stop loss is basically the same, the stop loss distance, but the take profit is different. The first one is take profit 1. So that's the same take profit that we have been using so far in this strategy. However, the second take profit is half of it. Take profit 2 is equal to take profit 1 minus half of the distance. So minus the take profit stop loss ratio divided by 2. And because this one here, the take profit 1 is equal to self data.close plus stop loss ATR times take profit stop loss ratio. We could write it in a different way as well. So the take profit 2 could also be the closing price of the current candle plus stop loss ATR coefficient ratio and times the take profit stop loss ratio divided by 2. So this way we're adding half of the distance. In other ways, we split the trade in 2 parts, 2 equal parts with the same size, and we just differentiate these with 2 different take profits, where one is the half of the other, basically. And same thing for the short positions as well. So it doesn't differ much. So I'm just going to copy, make it equal to take profit 2, because it's clearer this way, I assume. So minus whatever this is divided by 2. This time we're taking half of the distance. I'm going to comment this part. So we can test this, we can run it, and we can see that we have 2.15% in return versus the 8.39% without the break-even approach. And usually we introduced actually the break-even approach to try and limit the drawdown. So we have a maximum drawdown percentage of minus 2.8 and an average drawdown percentage of minus 0.49. Let's see what we have here. So we have minus 2.3 with an average minus 0.56. It didn't do a lot of improvement. And it also limited our returns in total. So 2.15 instead of 8.39. So we could skip using it. We can test all kind of combinations here. This is the beauty of this code and backtesting in Python, because it's free. You can pretty much try everything you want and come up with the best optimized situation or strategy for your own trading. Now, this one was one single iteration. We sliced minus 10,000 up to minus 5,000, and we fit the parameters. We optimized the strategy. We took the parameters, we applied these on minus 5,000 up to most recent candle. But we need to do this over the whole history of the data that we have. In order to do this, I'm defining these in a function. These can be written in a better way. I just wanted to make sure they work as quickly as possible to be able to release the video. But you can put the class outside, pass it as a parameter to the function, and write everything in a more elegant way. I apologize in advance if we have any computer scientists or software engineers watching this. Don't blame me for this one. It works, and you can rewrite it pretty much the way you want. This function called fit_parameters takes a data frame that we're calling the data frame test. So we're defining the signal function again. It's a local function now. It will return the data frame test.total signal. And then we define the myStrategy class. All the same. We are optimizing inside of the function. And then the function returns the stop loss coefficient and the take profit stop loss ratio after the optimization. So we're basically optimizing. This is a function that would optimize. I just pass it the data frame, the slice of data frame I need to use, and then it will provide me the best set of parameters for these. So this function will do the fitting or the training part. Then there's another function called test parameters. It takes the data frame for testing, the parameters, the input parameters. So these are basically those that we have found from the previous function, and it does the testing on the new data frame or the test data frame. And it will return the return percentage. So it's going to return from the statistics only the return percentage. And this is how we can use it. So we call test_parameters, we give it a slice of data frame, we give it the parameters, and it's going to provide the return and percentage. So this one is 7.54%. Let's run it again and see what it provides on the small data set. Yes, so it's 7.54% on the slice that we are interested in. And just to make sure that it's working properly, I'm going to put minus 5,000 up to the most recent candle. With these parameters, we should be getting around 8%, 8.39. So we are finding the same number as before, and this is a proof that everything is working. Here we don't have any bugs. Now this is where the walk forward is applied and the testing or the forward testing is applied. First, we need to define a period. So how much of a slice you want? A 5,000 candle slice, 6,000 or 10,000 slicing, depending on how you want to conduct your testing. Then half of it is simply an integer, which is half of the period. So here it's going to be 2,500, for example. And then we create a list, an empty list. This is where we would be appending our results, the returns results from each configuration. And then for I, in range between minus 60,000, because this is how many rows we have in our largest data frame or the CSV file that we have so far. So if you have a larger data file, you want to download something, let's say 5 years worth of data, you can change this to a larger number. Then we're going to apply between minus 60,000 up to minus twice the period here, and with a step that is equal to the half period. We print I just as an information while the testing and fitting are running, just to know where we are in this testing. And here the data frame, we're going to apply a slice. The first slice is called data frame underscore fit. So it's between I and I plus the period. And then the testing part is in the future. So it's I plus period up to I plus twice the period in the future. And the fitting here is happening on the data frame underscore fit. And the parameters are A and B. These are going to be used for the testing, which is data frame underscore test. taking into account the best A and B parameters found by the previous function. Then we append the returns, the percentage of returns in this list that we're going to use later on. So this is going to be a bit time consuming, depending on the size of the data you are passing. So in this case, it's going to be barely 1 minute, I think, or 30 seconds. So this is per iteration. So I'm going to have a coffee, maybe a chocolate bar, and come back when it's done. Okay, so now let's check the content of the list. So these are our returns. This is the return. So we have 13%, 5%, minus 6.7%, minus 9%, and so on. We can check the sum. Sum overall is 46%. So we need to be in the positive all the time, obviously. And we can plot bars for each period or slice we are testing. So we have positive, positive, negative returns, and so on. And then we can plot also the overall equity. However, just be aware of something. We're sliding the window by half the period here. So we're overlapping our testing to increase and enhance the number of the data and the number of tests we are doing. So if you want to do it the correct way, it would be every time increasing here the period, not by half a period, by a full period. In this case, we would mimic somehow a real case of trading, because every time, let's say we are fitting on 2 weeks of data, then we're trading for 2 weeks. Then we fit on these 2 weeks and then we trade in the future for another 2 weeks and so on. So to do this, we can use T period here instead. And now we don't have to multiply this by 2 anymore. We can limit it to T period. This is more realistic from the simulation point of view. However, if you want to enhance your data, we can do it the way we've been doing it before. I will run this again. Maybe this time I will go and have an ice cream. It'll take a few minutes and we'll get back. Okay, so now we have our results. We have 30%, 13%, minus 6.7%, 1.9%, and so on. We can check the sum. We have 34%, and we can show the returns for each of these slices of periods. So we have plus 13, minus something, plus, minus, and as you can see, when it works, it's working largely well, and sometimes it's losing as well. And we can plot the equity, actually the simulation, where we have kind of a stagnating equity for a while. So it's not much happening here, but then we have this spike that saved the results. I think this is not conclusive. We can't say that this is a profitable strategy, to be honest. We need to backtest this on more data, like for a few years. But at least for the year that we took into account, the data that we have, it looks like it's a profitable one. It's a profitable strategy. And this is including the forward testing. We're trying to fit, and then we are forward testing in the future. And this is simulating real life scenarios. This is how we will be doing in real life trading. We will try to fit on, let's say, the last 3 weeks of data, and then try to use the parameters for the coming month or for the coming couple of weeks before we try and fit and optimize again. And just to answer one of the questions that I have read in the comment section, like how much optimization is too much optimization? Well, there's no rule, there's no strict rule, but you can change the slice width here. So you can try and fit on the last month or the last couple of months and trade with the parameters for the next 4 weeks, let's say. Or you want to fit for the last 3 weeks and just trade for 1 week with the data, and then after a week, fit again on the most recent 3 weeks and so on. So there's no rule, there's no recipe to do this very easily. However, no matter what slice you take, if the strategy is fair and it's profitable, it will always be in the profitable side, on the profitable side. So it shouldn't matter much as long as you have enough data to fit on. So let's say 3 or 4 weeks should be enough on the 5 minutes time frame. This is good to provide the model with enough data to fit on and to study the market. And then you can trade with this with these parameters for, let's say, 1 or 2 weeks before fitting again. Now, if you are interested in the break-even approach, so it should be here. You can implement it and forward testing it. I kept it for you in the code. So when you download the code, you can use it. I want to keep this video as short as possible, so we're not going to test all the possibilities here. Some ideas would be optimizing, not only taking into account the percentage of returns, maybe maximizing the drawdown in a way because it's negative. So when you maximize it, you're actually minimizing the drawdown. Maybe maximizing the drawdown or minimizing the drawdown duration or any other things, maybe putting the date time as an index. And this would give us the access to Sharpe ratio, Sortino ratio, and Kalma ratio. And we could try and optimize based on maximizing one of these ratios, for example, in order to increase the number of signals instead of generating a signal based on the closing price, whether it's above or below the Bollinger Bands. In this case, we can also include the open prices of the candles, if a candle is opening above or below the Bollinger Band, and so on. There are lots of parameters and optimizations and possibilities that we can include and test in this strategy. All in all, it should lead to a fairly positive return. Don't expect a lot of returns. So as you can see, for a few weeks, you get around 10% per month or every couple of months. And also, as long as you're using it as it is, expect some drawdown durations that are quite long. So I don't like this. Here we have a slice of 5,000 candles. So that's around 3 weeks. So when we talk about this part, that's 3 weeks plus 6 weeks and then 9 weeks and so on. Notice, so it's like around 4 months where we haven't seen any striking performance. It's only the last slices of data that saved somehow the situation. So you might also want to change the 5,000 here. So this slice can be changed easily. You can put 6,000 or 8,000 or even 3,000 depending on your trading style. And maybe trying a different time frame. So here we've used the 5 minutes time frame, maybe 15 minutes or 30 minutes could be maybe with less noise. Maybe it would work better. I haven't tried these. So there's a lot of possibilities, but it's also a lot of work and it requires a lot of time. And this was it for this one. I hope you guys liked it and found the information helpful. Until our next video, trade safe and see you next time.